we've got our investment expert, Roger Montgomery. He's back to give us his analysis of the shares we should and shouldn't be putting to our portfolio. Let's talk about, say, JB Hi-Fi this week, because it's one of your favourite stocks.
Yeah, look, something interesting has come to mind for me on JB Hi-Fi, and I've been a big fan of it for a long time. That hasn't changed at the moment. But what I've noticed is something I think is quite important, and that is that as the company expands, and it's still got a lot of growth ahead of it, but as it expands, its best sites are gone. You know, the best sites are behind it. And so the new sites that pop up, they'll do well, but not as well as the ones that they picked first. You know, they take the low-hanging fruit first. That's a normal strategy in business. They're generating, this year they generated I looked at the results, they generated $94 million of cash. Now I have a balance sheet method for calculating that cash, but they generated $94 million of cash, $67 million of that went to pay dividends, $20 million of that went to pay off debt, which is now getting to a point where there's not going to be a lot left very soon. That leaves a ton of money that they really don't need. Now, why do I say they don't need it? The biggest asset on the balance sheet is inventory. There's $344 million of inventory there.
That whole lot of stock.
It's funded almost totally by the suppliers. Creditors is $290 odd million. They actually don't pay for their inventory and they don't need the cash. So I'm looking at this and I'm thinking, well, I know one of the big things about the best businesses to own are what I call compounding machines. They're businesses that can generate very high rates of return on equity, like JB Hi-Fi, and don't have to pay a lot of money out as a dividend, can keep it and re-employ it at very high rates. That's how you get these big increases in intrinsic value. My fear is that as this business begins to mature, the payout ratio will start to go up. There's all that cash that they don't need. They'll start paying out higher dividends, which means less will be retained and compounded. And in the way I look at valuations, that means that the intrinsic value won't rise as fast. So it's not plateauing yet.
So it could be
but
a
I
company
can see
where the share price is here to get intrinsic value, and might be a price you won't get out.
Well, at the moment, the price is below the intrinsic value, and the intrinsic value is still going up. But I can see a time now where that rate of growth in intrinsic value starts to plateau.